Welcome to The Explainer. Today, we're going to talk about a really crucial part of India's financial world, one that flies a bit under the radar. They're the specialists, the niche players who jump in when the big banks can't. We're talking about non-banking financial companies, or as you'll hear them called, NBFCs.
You know how it is, right? Your regular bank is kind of like your family doctor, a general practitioner. They're great for most things. But what happens when you need something really specific? Like, say you need a loan for a whole fleet of trucks, not just one car. Or maybe you need a very small loan for a tiny business in a village that doesn't even have a bank branch. Well, that's where the specialists come in. And that's exactly the gap NBFCs were created to fill.
So here's our game plan for today. We'll start by going beyond the bank to see what NBFCs really are. Then we'll meet the key players in the space. We'll dig into their business models, the risks and rewards. After that, we'll look at how analysts grade them. And finally, we'll wrap up with the strategic playbook. Let's get right into it.
All right, first up, beyond the bank. So what exactly is an NBFC? And why are they such a critical piece of the whole financial puzzle?
Okay, so at its core, an NBFC is a financial company that steps in to serve customers that the big traditional banks often can't or maybe won't. And to do that, they have to operate in a totally different way. They have unique business models, they face very specific kinds of risks, and they play by a different, often more flexible set of rules.
And here's that specialist versus generalist idea laid out nice and clear. Think about it. On one side, you've got the NBFCs, the specialists, targeting very specific niches. Now, the catch for them is they can't just take our savings deposits like a bank can. They have to borrow their money from banks or the market, which means their money costs more. But the trade-off? Their regulations are a bit lighter, more flexible. On the other side, you've got the banks, the generalists. They serve pretty much everyone and they get to use our low-cost deposits to do it. But because of that, they're wrapped in much stricter rules.
Okay, so now that we know what they are, let's meet some of the key players. Now, the NBFC world is massive, so for this explainer, we're going to focus on three major types that you absolutely need to know about. Just look at the numbers here. They really tell a story, don't they? You've got vehicle finance earning solid yields of 12 to 18% on loans that last about 3 to 5 years. Then, just look at microfinance. Whoa, incredibly high yields, sometimes up to 30%, but on super short-term loans, like 1 to 2 years. And then housing finance is the complete opposite. Lower yields, but they're playing the long game. We're talking 15, even 20 years. You can see right away, they're all in completely different businesses, each with its own personality.
All right, so we've met the players. Now let's pop the hood and see how they actually work. This is where we get into the nitty-gritty of their business models, the unique risks each one faces, and of course, the potential rewards.
The vehicle finance model, it's really built on one simple, tangible thing, the asset itself. The truck, the car, whatever it is, that's the collateral. And that's a huge safety net for the lender. Their whole playbook is about building super strong networks with vehicle dealers to find customers and having a crystal clear legal path to repossess that vehicle if things go wrong. It's a system built first and foremost on a physical asset.
Now, microfinance, it operates in a completely different universe. There are no assets to repossess here. These are unsecured loans. So you have to wonder, how on earth do they manage the risk? Well, the answer is relationships and social pressure. They often use a group lending model where the community itself kind of guarantees the loan. It's a high-touch business built not on physical collateral, but on social collateral, on trust.
But as you can imagine, that relationship-based model comes with its own very specific set of dangers. Borrower incomes are often tied to farming, which makes them incredibly vulnerable to a single bad monsoon. They can get hammered by sudden government rules that cap the interest rates they can charge. And then there's political risk. Just before an election, a politician can stand up, announce a loan waiver, and just like that, wipe out a company's ability to collect its money overnight. It's a huge risk.
Housing finance is fascinating. Why? Because it's really two completely different businesses pretending to be one. On one side, you have the slow and steady business of retail home loans to individuals. They're long-term, stable, and relatively safe. And then, you have the high-stakes, high-risk world of construction finance for developers. These are short-term, high-yield loans, and the risk that a project doesn't get finished is very real. One is a marathon, the other is a high-wire sprint.
So we've seen their playbooks. But how do you actually tell a healthy company from a really risky one? Well, that brings us to the analyst scorecard. We're going to give you the key tools, the metrics that the pros use to take the temperature of these lenders.
For a vehicle finance company, an analyst's eyes go straight to asset quality. They're looking at something called gross non-performing assets, or NPAs. That's just a fancy term for bad loans that aren't being paid back. You really want to see that number below 2%. Then they check profitability with a metric called return on equity, or ROE. Anything over 18% is considered really, really good.
Microfinance, it kind of speaks its own language, so it's got its own metrics. The big one here is portfolio at risk, or PAR. Think of this as their real-time health monitor. It shows exactly how much of their loan book is overdue. You're looking for a number below 5%. And when you see that, combined with a collection efficiency of over 95%, that's when you know their high-touch field model is actually working.
Okay, so we've looked at the models and we've looked at the metrics. Now let's put it all together in our final section, the investment playbook. This is where we zoom out and take a big picture, strategic view of this whole landscape. This table right here, this tells the whole story in one snapshot. You can see that classic risk-reward trade-off in action. Vehicle finance, it gives you high growth potential for a medium amount of risk. Microfinance, on the other hand, offers absolutely explosive growth potential, but you have to be willing to accept the high risk that comes with it. And then there's housing finance, your steady, moderate growth, lower risk player. Each one has a very different role to play.
So how might someone think about balancing these different profiles? Now, let me be absolutely crystal clear. This is just a conceptual framework. This is not investment advice. But you can see the logic, right? You could build a core with the stable growth from vehicle finance, add the defensiveness of housing finance, and then maybe add a slice of high-growth microfinance as a kicker. It's all about strategically balancing risk and reward.
And all of this gives us a really powerful decision framework. If you were ever looking at a specific NBFC, this is the 6-step checklist you'd want to run through. First, understand the business model inside and out. 2, analyze the asset quality. 3, review their funding profile. 4, check out the management team. 5, know the regulatory landscape. And finally, number 6, assess its valuation. It's a methodical path to a smart conclusion.
So after all of that, what are the key things to walk away with? First, for NBFCs, specialization is everything. It's their competitive advantage, their superpower. Second, they operate in a world of higher risk, but also higher potential return than traditional banks. Third, funding is their absolute lifeblood. Having cheap and varied sources of money is non-negotiable for survival. And finally, number 4, regulations can change the entire game in an instant, so you have to pay close attention.
If there's one single sentence that just perfectly captures the essence of NBFCs, it's this one right here. Their focused approach creates competitive moats in specific segments, offering higher returns but requiring careful risk assessment. That really says it all, doesn't it? It's that constant tightrope walk between a specialized opportunity and a specialized risk.
Which leaves us with one big question for the future. In a world that's going digital first, will these specialist lenders use new technology to innovate and thrive, or will they ultimately be disrupted by it? The next chapter for India's specialist lenders is still being written. Thanks for joining us on The Explainer.